What are your thoughts on the last hour trades?
In fact, that scares me. Tells me that there could be a short trap here. Possibly, if it closes where it is today, the setup is such that it could open at the bull gap tomorrow and go up, trap the shorts. However, I still have shorts. Jindal still looks weak to me. Stop above 175, could see a slide to 166. And Reliance as well, perhaps looks weak again. Targets on the downside is 1360, stop about 1398.
Okay.
It's a make or break.
Okay, make or break. Interesting point Prakash is making. If we indeed close here, then what happens to the shorts is something we'll find out. But let's talk about the sector that has started to see some kind of derating. We're talking about the FMCG space. The stocks are really under pressure on the back of muted results and concern of slowdown. Now, is this temporary or indication of a long-term structural problem? Also, how should you value these stocks now? Because in the past, we've given 50 times, 55 times, or sometimes even 60 times to some of these companies. Rahul Arora is with us, of course, CEO of Nirmal Bang, Institutional Equities. Rahul, good afternoon. Thanks a lot for joining us. Before I talk to you, I just want to present one table on the FY20 valuation. Of course, this is the data that Mangalam has given us in terms of how the stocks have done. Most of them have fallen about 10 to 20%. In certain cases like Godrej Consumer at 52-week low, down 34%. But this is the valuation table that we're talking about right now. Lever, of course, trades at 52 times. You may say that Lever is perhaps Salman Khan of the market or the top star, so it deserves the kind of valuation that it's getting. Britannia is now down to 46 times. Godrej Consumer is now down to 39 times. Rahul, your thoughts, first of all, on these valuations, whether they need to correct a bit more. And for starters, this FY20 numbers that we're assuming right now in our Excel sheets, they themselves need to adjust downward. And, in a sense, that would mean some more pressure on the stocks.
So, Anuj, first off, thanks for having me. I have a little table of my own, which I was reading on the way here. So, I think, Anuj, the way people are looking at 1 year forward sadly has changed. So while we are still traditionalists looking at FY20, a lot of investors are already looking at FY21. But your point is well taken. I am in full concurrence with the numbers that you are throwing up there. I think, Anuj, you need to ask yourself, why do you buy these stocks in the first place? So that's, as I was coming here, that's the first point I was trying to think of. And I was listening to the Hindustan Unilever conference call. And 30 out of 31 quarters, he has shown you margin expansion. And 8 years running, he has shown you sales and profit growth. Now, contrast that to something like a Dabur or an Emami, where you are seeing gross margin declines, EBITDA declines, and net profit declines. So I think if you look at, say, the FY21 numbers, while I'm not contesting on FY20, they still look expensive. If you look at, say, an Asian Paints, Lever, Nestle, United Breweries, they're still trading at closer to 40 times. You have a Dabur, sort of a Britannia, and maybe a Marico that's about 35. And then you have Godrej Consumer, United Spirits, maybe at the 30s. Titan would probably be somewhere also at the upper end of the 40s. Emami and ITC are probably in your mid-20s. I think this is, while the sector itself, and the word you used is a very valid one of derating, because if you see some of these stocks like Emami and Godrej are down 50-60% from their 52-week highs. Something like a Britannia or a Dabur are down 30%. Even a Lever or a Asian Paints, they're all down about 10-15%. But the degree of fall, I think, is commensurate to earnings. I don't think there is no method to the madness. I think the way institutional investors have reacted to these numbers and the call that they're taking has a lot to do with earnings than just the P's that they were trading at. Your point is valid that Lever is still at 40 times, probably trading, 30 times maybe more expensive than a Godrej Consumer. But when you look at a Lever with the stats that I just told you, 30 out of 31 quarters of operating profit margin expansion, you will always give it a premium. Now, will these settle at these levels of valuations? My sense is they are approaching a buy zone. I don't know how much more they will derate from here, to be very honest, especially in the context of the global noises we've heard overnight. And if you're looking for a margin of safety, I think they're probably approaching a zone where you could start looking at them.
Okay, hi Rahul, welcome to the show. So, let's talk a little bit about Godrej Consumers, because not only were the numbers weak this time with a 1% volume growth, something that we haven't seen in a very long time. Remember, they used to do 18-20% for the longest time. The commentary did not inspire any confidence for a turnaround in the near future. It's still trading at almost 40 times, right? What do you do with a stock like this now if you have been a long-term investor and have created wealth in the past?
So I think, Sonia, the one big factor that's always deterred us from Godrej Consumer is the inorganic and the international exposure, because that exposes you to a lot of cross-currency headwinds, which is probably not in a lot of other listed FMCG companies in India. The kind of acquisitions that GCPL has done over the last half decade or even more than that is a bit of a concern. Now, the important part is that in none of the FMCG companies are we talking about a 15% plus top line growth. Any FMCG company you pick up, including HUL, which Anuj mentioned, if you strip out the GSK component, even Lever is not going to grow at 15% compounded for the next 2 years. You're probably looking at, say, between 5 for the lower end of the spectrum and maybe 12 to 14% kind of for the upper end of the spectrum, which should probably be your Nestle's, Levers, Britannias of the world. So I don't think Godrej is probably the best pick to play, despite it coming down by about 50% from its 52-week high. The traditional rule of thumb has been, if you speak to any of these managements, and I followed some of them on your channel, is that rural typically grows at about 1.2 to 1.5 times the urban. For all of these companies now, rural has seen a bit of a downtick, which now puts so much emphasis on the upcoming monsoon and perhaps what the new government will do in its immediate budget to spell out consumption. It's probably not been seen for a while. So I think Godrej, despite the derating and the volume growth number that you say, I'll probably stay away from it. So also for Imami, and so also perhaps even for a Colgate, for which I have been a shareholder, and even an ITC. These are probably stocks I wouldn't buy even at this price, despite the price and time correction that you have seen, just given the earnings outlooks.
What about a stock like Britannia, where of course, the last decade or the last 5 or 6 years was, I think, the dream chart that, you had 600 rupee to 3600, 3700 at its peak, I think. That was the stock of Britannia. Now at 2600, 2660. Your thoughts here?
So Anuj, I'll break this down into two parts. One is, of course, the immediate concern that people had on the conference call, which was with the intercorporate deposits. I think that has sort of hurt. But that's, notwithstanding that, I think if you just see the margin expansion trajectory that Britannia has done, it's phenomenal. I think in the context of, the current results also that you saw, the kind of pressure that you saw on margins for a Dabur or, Imami that you saw in the third quarter, they are not there. The innovation pipeline is so strong. I mean, just see what they've done in the last 6 months with Treat, with the whole wheat Mari and things like that. I think the contribution from the new business. So, Anuj, when I look at FMCG, just simplistically, I'm buying it for three things. I'm buying it for penetration, distribution, and premiumization. Britannia fits into all these three verticals as far as I'm concerned. So, I think notwithstanding the pressures that you have seen on the ICD side post these numbers, I still think Britannia will grow its margins by about 200 basis points and probably compound its EPS by between 18 to 22%. It's a company that gives you about a 42% return on capital employed and close to a 35% return on equity. If I'm going in and paying a 35 times for it on FY21, or maybe close to, say, kissing 40 times even on FY20, I'm not extremely uncomfortable doing that in the context of maybe the growth that I'm seeing in other sectors or other stocks in the FMCG universe itself.
On Dabur particularly, I think that was one of the first few ones that really shocked the street in terms of their volume fall. I mean, last quarter in Q3 they did 12.5% volumes, and this time it's just 4%. Is there any reason to still keep the faith here, or would you be cautious?
I wouldn't say to throw in the towel on that, Sonia, because if you see the hair and the food part suffered in Dabur. The oral care, the home care did all right. The skin care also did pretty well for them. They're not the most expensive stock on the planet today, so I think there is a valuation comfort. More than there is a growth comfort, there is a valuation comfort, and I'll probably be inclined, if you wanted to play, say, between a Marico or a Dabur or an Imami, one of those names, I'd probably put Dabur at the top of that pecking order. The point is, even if you just go back to the point Anuj was making at the start of this conversation about Lever sort of being the Salman Khan of the FMCG universe, if you see between the personal products, the foods business, and the soaps, the interesting part is that Lever's numbers actually got hit by the personal products division, which grew only 7%. The other two verticals actually grew by 12%. The profitability in the other two verticals grew by 20% apiece. But for the slowest growing vertical, there was still a 150 basis point EBIT margin expansion in that vertical. So I think FMCG from here, for your viewers and for investors, they need to buy it for margin expansion, other income growth that is going to come in, especially in the case of HUL, where you're going to get 4,000 crores flush of cash from GSK. So, and none of these guys have any interest components.
So what are your top recommendations in the space?
I'll probably say lever Nestle and Britannia, and maybe just on a valuation comfort, probably United Spirits. But like I said, none of these, don't expect them to grow 15% north. You're buying these companies for margin expansion, other income growth, and therefore a profitability growth, which would probably lend some comfort.
Okay, we're running out of time, so I just wanted to ask you one last question. Since you interact with a lot of these managements, one other feature has been the cut in ad spends for some of these companies. Is it because of the slowdown, or is it because companies are getting smarter and focusing on, not the traditional mean of advertising, but we all, for example, use our Facebook, and if we watch any video, there's no way we can watch it without seeing an ad. You can't just skip it. So is that the reason that you've seen this?
I think you've answered the question yourself, Anuj, because if, I'm sure Mangala was on the lever call, you can ask him, they spent a little bit of time discussing the digital strategy. So I think the advertising, the way traditional companies are advertising has moved quite substantially. The other very important factor, Anuj, is had we had this conversation 12 months back, the one national obsession was Patanjali. You don't hear that to a large extent today. So I think that big headwind, so to speak, though it was good for the FMCG market, I think Patanjali came in and expanded. But that today is not spoken about in the same breath as it was then, regardless of which vertical you picked up.
No, I completely agree with that point of view. I think there was this phase which we went through. That is well and truly over, without a doubt. So the reason I was asking you this question is that even if there's a strong pickup, is there a chance that the ad spends now sort of settle at much lower level than we have become used to seeing over the last, say, many years?
See, Anuj, it will be on a case-to-case basis, and let's just pick up Britannia. If you see the campaign that they just started last week, the World Cup Jao campaign. So I think it will sort of be sporadic in nature, but I don't. Let me put it this way, I don't foresee any of them taking out their FY18 highs of ad spends to a percentage of sales. So I think in some of these companies also that you've seen declare their results, it's large, the margin pressure, whatever little you've seen has been employee costs as a percentage of sales or other expenditure. It's not by and large been because of advertising. So I don't think you're probably going to exceed what you saw a year back in terms of ad spends as a percentage of sales, but it could be very specific on quarter, like I said in the case of Britannia and the upcoming World Cup.
All right, Rahul, thanks a lot for joining us and taking us through all your stock recommendations. Rahul's disclaimer, of course, will flash on the screen. If it doesn't, we'll do that after during the break. We'll take a break and, of course, come back with the market closing. It's still down about 120 points on the Nifty and about 400 points on the Sensex.
Union Bank of India presents Top Nifty Gainers.